Hello and welcome, and in this stock analysis video I will share with you my simple investing process which has helped me get a consistent return of over 20%. In today's stock analysis video we are going to examine GameStop. First, let's find out about the company. GameStop was founded in 1996 and then was later IPO'd in 2002. GameStop is a retailer that specializes in providing games and entertainment products through its stores and e-commerce platforms. During our stock analysis, we're going to explore the key pillars, examine the ownership, look back at past results, we'll find out what the analyst predictions are, as well as giving the business a valuation, and examine the potential return on our investment, and finally we will summarize our findings. Let's start by looking at the key pillars for the trailing 12 months. In the book Rule 1 by Phil Town, he suggests that these are the key metrics when first evaluating a business. The first pillar we are going to explore is the earnings per share. This is where we take the net income and divide it by the shares outstanding. The higher the number, the more profitable the company. Earnings per share has gone up 102% in the last 12 months. Now let's look at the free cash flow, which is the money a business can generate from its operations. Free cash flow is down by 530%. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. And their revenues decreased by 11% this year. Book value is calculated by subtracting the total liabilities from the total assets, and this indicates the equity growth for the company. And book value is up just by 1%. Now we want to turn our attention to the management of the business by looking at the return on invested capital and the return on equity. These two measures allow us to assess a company's efficiency at allocating capital under its control. Return on invested capital is 0 and return on equity is 1%. Now we move on to debt, and Phil Town prefers a company that is able to pay off debt with their free cash flow within 3 years. GameStop currently have $603 million worth of debt and are currently making a loss, so they can't use their free cash flow to pay off the debt. In this next section, we will now focus on other key metrics which will help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. This is very low at 25%, and we would like to see a gross margin at least 40%. Next we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying any interest or tax. Operating profit margin is currently minus 1%. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for a company that has a free cash flow yield of 5% or higher. The free cash flow yield is minus 2.35%. As we are potential shareholders, we will now want to look at the average book value growth for the last 10 years. The average book value growth for the last 10 years is 8%. Ben Miller believes earnings growth is the biggest indicator to a company's stock price. The average earnings growth for the last 5 years is minus 6%. I've included a link if you want to check out the investors page and see the annual report. This is Bitesize Investments, giving you a step-by-step approach to your investment journey. There is currently just one super investor who's bought this company. If we look back at Ken Fisher's previous sales and purchases, we can see he's both bought and sold shares in GameStop in the last few years, and has increased his stake in the last 2 quarters. There have been no super investors selling in the last quarter. Now we look at the past historical prices of the company, as this will help us build a picture of periods of success or failure the business has been through. If we look back at the past performance of GameStop, we can see from 2014 to 2020 that GameStop's share price was slowly trending downwards, but radically increased in 2021 and has been trending downwards again ever since. On average, the analysts believe the price target should be about $5.60 and have a price target of $7. Analyst reports suggest that GameStop is greatly overvalued at the moment, and the overall consensus is that GameStop is a sell. And collectively, the analysts believe the company will continue to decline in the future. So I'm going to use the earnings per share of 0.2 as my starting point when creating a valuation. As the outlook for GameStop looks bleak, and just to prove how overvalued this company is, I'm going to give it an estimated growth value of about 20%. As currently the PE ratio is 1010, I'm going to give this a more realistic PE ratio of 40. After that, I'm going to project these numbers forward by 10 years. This then gives me an estimated future stock price of $5.44 per share for its future share price. Then we need to include our 15% return, and then we work out the current value, which Philtown calls the sticker price, which is $1.34. And then we apply a margin of safety of about 50%, and this gives me a buy price of $67. Or at 25% it gives me a buy price of $1.01. As we can't rely on just one valuation model, I'm going to dig a little deeper and gather some more information. If you found this video useful, click on the link to check out my last stock analysis. In this next section, I'm going to get some help from some super investors. To start off with, I will use the Peter Lynch PE ratio model to help determine if the share price is overvalued, fairly valued, or undervalued. So we take the share price, add the dividend yield, and divide it by the current PE ratio. Okay, so using this model, it suggests that GameStop is very overvalued. Then we're going to move on to Warren Buffett's 10 cap model, where you divide the free cash flow with the market cap. The higher the percentage, the more the company is undervalued. So at -2%, this also suggests that the stock is overvalued. After that, we're going to move on to Joel Greenblatt's favourite tool for working out if a company is correctly valued, which is dividing the enterprise value by the earnings before interest and tax. At -170, this suggests a company is overvalued too. Finally, I've also included Philtown's earnings per share growth model that I used earlier. Using the Philtown earnings per share growth model, it gives me a buy price of just over $1, and currently is at $22. If you're interested in reading any of the books by the super investors I've mentioned today, please look in the description to find out more information. The return you would have received if you'd have bought at the 52-week low of $10 and then sold at the recent high of $49 would have been 390% if you'd have been smart enough to sell. GameStop has many competitors and they don't have a moat, and its recent resurgence is due to outside influencers rather than the key metrics of the company. Roaring Kitty's re-emergence with a meme has encouraged the market to surge for a couple of days, but again has now started to fizzle out. If you've enjoyed the video, it would be greatly appreciated if you would like and subscribe to help the channel grow. And finally now we'll summarise what we found out about the company. When reviewing the key pillars, GameStop scored 1.5 out of 12. Under ownership, one super investor has bought in the last few quarters and none have sold. Historically, the share price has hit some amazing heights, but the prices are based on outside influences rather than the fundamentals of the company. Analysts are indicating that GameStop is a sell, and they're predicting the company will decline about 8% over the next few years. Using the different valuation models, my buy price would be less $1, but personally I wouldn't touch this company with a barge pole. GameStop doesn't have a moat. My final overall rating is a generous 1 star out of 6, and I've given this a category E rating within my own stock watch list, but after reviewing this company's fundamentals, I'm considering creating a Z category. Thank you for joining me during this stock analysis video. As I'm a relatively new channel, please consider using the comment section to help me develop the content I am creating. And don't forget to like and subscribe.